Good morning, good afternoon, good evening, irrespective of where you are connecting from. And good to have every one of us back into this session, right? And I'm glad you made it. Time out with Victor on Financial Money Bootcamp. It has really been a great session so far, so good. So we are going to kickstart the session while we hope others, our colleague, will join us. And today will definitely be a special day. Trust me on that. Of course, I will be hosting one of our sponsor and our support in this session today. Yes. So I'm saying my greetings to every one of us. Glad you are able to make it to this session. So, without wasting much of our time, all right, let's get straight into it. Let's appreciate our sponsor and our supporter, the Brand Consulting. That's the company I currently work with. Microsoft, because I'm also a Microsoft MVP, most professional, most valuable professional, uh, right? And also have my colleague here with us today, Adedolamu Shogilala, and I'm going to just give us a brief about him. So here I have him. His name is Adedolamu Shogilola, a chartered accountant. Yes, he's actually a fine boy, right? As you can see, I decided not to use his corporate picture. All right, he's a very lively guy. We both attended the same school. My very close friend. When you have great friends, trust me, it kind of when you have a friend that motivates you, and I think life is all about motivation. They just tell you that hey, you can actually do the impossible things. So let me just give you a brief about him. He currently work with Deloitte, right? He work with Deloitte Nigeria, one of the big for consulting firm. He's an outstanding tax analyst with over 2 years experience, right? Anything about tax, this guy is on point. Right, I don't know. It decided to just switch from being a tax guru to an outstanding financial analyst, and is a seasoned valuation and modeling analyst with over 3 years of experience. Yes, it's vast. Trust me on that. So he's still working with Deloitte, and it will be one. I will be the one that will be facilitating our valuation class today. He's also a graduate of Obafemi Awolowo University, where he studied um, management and accounting with a distinctive grade. Yes. This is a very close friend of mine. We both attended the same school. We both started from zero knowledge, right till today. I also he once worked with Stanbic IBTC as well. Oh, I forgot to even add his service experience. Yes, he's a great teacher, right? He tutored great minds as well. I can train to be a chartered accountant and the whole thing. So this is a great is a great man, and it's also one good thing about you being a modeler, evaluation analyst. You need to have, as I said, there are a lot of things embedded in you. You are a financial advisor, right? You're a business manager. There are a whole lot of things. So the Dolamu, while we're in school days, it was such a great experience, right? And maybe we're going to have some mentorship class one of these days. So our young guys really need to understand that life is all about stages, and you just need to go through something. So while in school days, it was very, it can just be great. Yeah, that's what we can say, because there are times you just don't have anything to eat and no no way to get money or stuff like that. So he owns a business then, so he has this business management skill. He was a CEO. Yes, though he didn't call himself a CEO, right? But he has this business he was managing on his own. After class, right? He had to go back home, go back to his hostel, set up he has one. I'm not going to tell him about that business. Maybe you can ask him. You can ask him when I hand over the mic to him. So he just set up his own business outside and started making money and the whole thing. So he was able to balance life with work, because you just need something to be to feed you that extra cash. You are right. I had the same thing at my own end. So when you just have that great uh group of friends, right? That you live life in reality. We're not in hurry, right? We took our time. if you have this small money, we value it, we think about how can we make it double and all those things, and not in dubious way, right? We
Mm,
believe in our own
mhm.
hands work and
Yeah.
the whole thing. And that's how we got here, right? So he owned the business
Mm.
and he managed some personal business as a student. So his mic is already open. So let me just hand over the mic to him so that we get started. He owns the session today. I'll just be at the back end support and the whole thing. So Adedolamu, the mic is let me hand over the mic. You can as well share your screen if you would like to do that, and you have the
Okay.
floor.
Oh, okay. Thank you very much, Victor. To be sincere, yeah. I didn't know this part of you that you can be a great MC. Of course, I know you are funny. I know you are all everything. This Victor guy has a great talent. Is multi-talented. But I really don't know that you also know how to. Let me just say, how do they say it in clubs? What do they call these people? How to hype somebody. Well, that's just on a lighter note. I just want us to ease the tension. I want us to know that this place is just to learn. And I'm happy to be sharing part of my experiences with this class. Like Victor said, I started as a tax analyst with Deloitte. After some time, I moved to financial advisory where I currently work. Before Deloitte, I had the opportunity to work briefly with Stanbic IBTC Bank in their corporate and investment bank and division. It was really brief because of course I would rather start with a professional service, and then we can go anywhere from there. So the experience has been good. It has been awesome, and like he said also, when I was in school, now we all had our stories how we try to survive, and then while you are refusing to do some things that you feel like, no, I can make it in a better way. Let me just stay true to myself. That's just like a brief introduction. Yeah. So, like you said, I'm Adedolamu Shegelola, and if I don't mind, would really want this class to be an interactive session. And let me quickly apologize for the fact that I've not been available for the previous classes. I'm so sorry about that. It's when you have multiple engagements, you just have to sacrifice something for something. I'm really sorry about that. But I've seen the model. I quickly I ran through the model just to see, okay, where are we going to start from? How are we going to kickstart the valuation, and just to understand how the business, like the business we built the valuation for, I mean the model for, what's the plan, what's the basis, then we'll know what we are trying to do. Okay, so I've heard Victor's voice. I would like to hear somebody else say something, so I'll be certain that we are together and then we are paying 100% attention, because of course the essence of this class is to show that we are willing to learn. Is to just show that no knowledge is a waste. So please, I would just want somebody to say one or two things just to be sure that we are together.
Trust me, we are together. And okay, so
Hi, morning.
let's welcome our wonderful
Anybody,
analyst.
just 1, 2, 3 people. Let's just say hello, hi to the whole
Hi, good
class.
morning.
Hi.
All right. Thank you, everyone. Thank you, everyone.
Hello,
Okay,
good
so
morning.
yeah, good morning, everyone. So let's dive deep into the essence of this class. I had the opportunity to join the first session where we were trying to deliberate on what kind of business do we want to build model for. Yeah, if I remember correctly, I know there were lots of suggestions. Some people suggested pharmacy companies, some people suggested retail business, some people suggested tech companies, and some people suggested fintech. And I think we casted votes then, and then the fintech company, they won let's just give it to them, because I remember I was part of the team that suggested, I think, pharmacy, but it's fine. They won the ground, so we allow them. Okay, so this morning, yeah, I'm so sure Victor would have done justice to majority of the assumptions that we used in building our model. Please let me just say this. Valuation is just like an art. Like, there's there is no fast and hard rule about valuation. Yes, there are principles you need to follow. Yes, there are things you need to know before you can say you want to value a company, an asset, or whatever you want to value. But trust me, there is no hard and fast rule. Just make sure that whatever assumption you are making, whatever reasons you are giving, just make sure it is logical. And when you are explaining to anybody, they would say, okay, this is reasonable, this is not reasonable. For example, let me just share briefly part of what I face on a daily, being a valuation and modeling analyst with Deloitte. There are times that you do a valuation. Let's say you are valuing a company or an asset or something, and then okay, there is this bank, one of the big banks in Nigeria that we are currently working on. Of course, I'm not allowed to mention them because of confidentiality. So it's not really valuation, it's an impairment test. Don't worry, when we get deep, we'll understand that there are various aspects of valuation. So what people mostly think about when they hear valuation is probably you're trying to value shares, you're trying to value company, but there are various aspects. There are several things you can value. It doesn't have to be a company or shares or something. So the impairment testing is also part of valuation because the logic is the same thing. Some of us that are accountants here, sorry for apologies to the non-accountants. This is not an impairment class, but the accountant or anybody that studied accounting or that has a brief experience with accounting will understand what I mean by impairment. So we are trying to test impairment for a particular bank, and then after making several adjustments, one also the bank invested in a subsidiary, and then they are trying to check their impairments, how is it going to be, and all that. And then we told them that one of the entities that they invested in currently is impaired in their books. Trust me, the bank, of course, the top guys, when I say top guys in bank, I mean the CFO, the big weights in the bank, they are like, no, because trust me, no entity, just like you, man, just like individual, you don't want to invest in something and 2, 3 years down the line, they're telling you that the value you paid for this particular something is, the value you are carrying this entity in your books is too high, you have to bring it down. People that know impairments, they already understand what I'm talking about. They're saying, okay, for example, you have this bank in your books, it's recorded as at 1 million naira, and then we are telling you that currently we don't think this bank is worth 1 million naira. We are telling you that it's worth only 600,000 naira, and then the person, you don't expect the person to receive such information with open hand. Of course, they want to drill down what you have done, how you have arrived at your 600,000 naira and all those things. So we are trying to, people will push back. The CEO will tell you, I mean, the CFO will tell you that, see, we are the owner of this business. We know better than you. You cannot make this assumption for us. This, they have done it wrong. And you as a valuation analyst or as a valuation expert, you just have to stand your ground to say, sir, you are right. But looking at this particular situation, looking at this scenario, looking at this, looking at that, this is the reason why we arrived at our conclusion. And trust me, most of the time they will tell you that, okay, know what, we get an independent person to also look at this thing. So the only sense of telling this story is to let you know that what really matters in valuation, yeah, in as much as you have to, of course, there are basic things that you must put into your value when you're doing your valuation. In as much you just have to make sure that it's reasonable. It's an art. Trust me, it's not. I'm not trying to ridicule any profession, but it is not accounting whereby when you pay, when you sell this, you debit this, when you buy this, you credit this. It's more of an art. You can play around. Just make sure that you can justify whatever you're doing. This, which is the same thing as model. The model we built, we can see that our assumptions, like Victor taught us, in making our assumptions, you can think outside the box. You can just play around. That's the beautiful thing about this thing. But of course, you don't make unrealistic assumptions. Okay, so sorry guys, I really don't have slide or PowerPoint presentation to be showing us, but because I feel the major reason for that is because this session is supposed to be a practical session. It's not supposed to be so a session that will just look at slides and then we'll talk about it and then they ask you questions in the next 2, 3 months. Okay, what is this? And you're saying I will have to refer to, this is supposed to be a practical session where we talk, where we gist, where we learn in the process. Okay, so let me just give us brief history. I mean, brief overview of valuation. Like I mentioned earlier, most times when we think of valuation, we're thinking about valuing business, valuing shares. No, we value a whole lot more. Okay, so we value a whole lot more than just business. So there are times that we value assets. There are times that, like I mentioned, we do people again good impairment and goodwill impairment or asset impairments. There are times that we do. Sorry guys, I'll still share my screen because I just want to dive straight into Excel by the time I start presenting my screen. Okay, so there are times that we do, there's something we call purchase price agreement, PPAV. So we do that when after a merger or acquisition between two entities, and then we are trying to, allocate when companies merge, they don't just say, okay, this is, we are merging with company A and that's all. There are components of that company that you want to attribute value to. You get. So that's when we do PPAV. Sorry, that's purchase price agreement valuation, and then we also do asset impairment. We do goodwill testing. For example, I've done a valuation of an oil company in one of the big oil companies, and we are not really valuing the company. What we valued was just, are we still together, please?
Yes, we are.
Okay,
Yes, we
okay.
are.
All right, all right. So I,
We
I
are.
said, all right, thank you. So I said I've done evaluation where what we valued is not the company itself, but the components. When you're talking about oil companies, you can just like I think if you still remember this concept in accounting, compartmentalization. I think I'm correct. Where they usually use plane as an example. You can't say the value of one part of a plane is the same thing. You can't, if you want to value a plane, you can't say, okay, the value of this plane is just so and so based on the size and everything. There are different components that you have to value individually. So the same thing applies to this oil company. They have different investment, they have different assets, and then you can't just say this company is worth so without first of all looking at each asset individually. So I've done evaluation whereby we're just basically looking at the oil rig, we are looking at the field, we're looking at several things before we arrive at the value um, of the company. So the valuation is a little bit wide. It's not something we just it's not just shares. It's not just business valuation. It's not just assets. It can be anything, of course. And the truth is, for anybody that wants to specialize in probably valuation and modeling, it is advisable to just pick an industry because trust me, well, for a start, you might want to have the basic understanding of everything, but as time goes on, you discover that if you don't specialize, you just end up being jack of all trade because the principle that we apply in a real estate, for instance, is not the same thing that we apply in a financial service. It's not the same thing that we apply in an oil company. It's not the same thing. So there are things we need to learn that are specific to each industry. And I'm sure Victor has done justice to that. Our example this morning is financial services. Yes, it's a fintech. Yes, I've seen the model that we've done one or two things. We've done okay. So don't know when we get there, we'll see how we start analyzing all these things one by one. So now another thing to quickly talk about is the type of valuation approach that we have. So there are three basic approaches. Of course, we still have several methods under each approach. For example, the first one I want to talk about is the income approach, and then we have the market approach, and then we have the replacement cost approach. So when we are talking about the income approach, yeah. So this the name suggests, what we are trying to do is we are trying to get the value of company A using the income of company A. So let me say this in another way. So when we are talking about the income approach to valuation, what we are simply saying is, okay, so before we do the income approach, like this particular one, this model that we have, I want us to use the income approach to value this our fintech company because, of course, when we are using the income approach, we first of all must have our forecast, because that is what. So when I say forecast, we are trying to look at, okay, we want to get the value of this company today, and of course, looking at this company today, it won't be right to say we want to use their historical performance to know what their value is today. What we rather do is to say, okay, what are they like? What is their performance going to be like in the future? And then we try to discount the performance, the future performance into today. So that's how we arrive at the value of that of whatever we are valuing this asset. But in this case, let's say business. Um, that is how we arrive at the value using the income approach. Sorry, just a brief summary. And then when we are talking about, of course, when before I move to a market approach, so when we are looking at the income approach, that this is where we start looking at. Okay, so I have a question here. Somebody saying by performance, do we mean cash flow or profit? Of course. Let me use this time. It's going to be free cash flow. Okay, so let me just delve a little bit into that. So by the time we start looking at our valuation, I won't have to be going back into that. So what I mean by free cash flow is this. So companies when there is difference between profits and cash flow. Yeah, I'm so sure Victor would have talked about this. Profits, like we all know in accounting, profits is not just cash. Profits can be accruals, can be receivables, can be, of course, when you sell something, you don't necessarily have to receive the payments in that particular period, but the company will record it as revenue whether they have received the payments or they have not received the payments. They record it as revenue in their books, and of course that will trickle down to their profit, and which is why we always have our cash flow statement to show the fact that, okay, say yes, you have made profits of 1 million, but your cash, what is it saying? And like, I mean, I'm sure Victor used to say this phrase that cash is king. What we read, because if you want to pay your suppliers, if you want to pay, if you want to meet your own obligation as a company, you must have cash. You won't just be meeting obligation. You want to pay your interest on your borrowings and all that. You need your cash. So what really matters is the cash. So when we are talking about performance in valuation, we are talking about the cash flow and not just the profits. And of course, I'm not trying to say profit is not necessary, please. We Of course, we know that we arrive at cash flow at our cash flow from our profits, after making adjustments for non-cash items and all those things. So we arrive at our cash. So what we usually do is to use our cash flow. And of course, we know that cash flow can be free cash flow can be into two. We have free cash flow to firm, and then we have free cash flow to equity. So when we are talking about free cash flow to firm, that is to that has not considered the impact of interest. So what the cash flow is simply saying, the free cash flow to firm is simply saying that this cash flow belongs to, of course, after taking out all other expenses, this cash flow belongs to both equity holders and debt holders of the company. So when we are trying